Good afternoon, and welcome to another exciting episode of Bond Squad After Hours. Today is my FOMC post-meeting recap. Before we get started, let's do our disclaimer. Investment advice is offered through Private Advisor Group, a registered investment advisor. WS&M LLC and PAG, as well as Bond Squad, are separate entities. The opinions voiced in this material and this broadcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance reference is historical with no guarantee of future results. Again, somebody please tell the MPT guys this. So we're here again, broadcasting to our readers. And so we had the FOMC meeting, and the FOMC decided to leave the Fed funds rate range unchanged. And, although I am disappointed by the fact they did this, they did come up with some pretty good reasons. And we took copious notes of both the statement, which I have over here, and during Ms. Yellen's press conference. And things that stuck out to me was Ms. Yellen said in the press conference that the inflation outlook softened. It should be transitory, but the inflation outlook has clearly softened, and that the 2% inflation rate might not happen until 2018. And by that I assume that the Fed chair is referring to core PCE, which is supposed to be the Fed's favorite measure of inflation. So the Fed also expressed concerns about the global economic situation deteriorating. So the Fed is now unabashedly looking at overseas conditions, and there was one statement here that was very telling. Where was it here? Global economic financial events may restrain economic activity, and by that they meant the U.S. economic activity. So that's how Bond Squad feels, is that you could have China, the other EM countries, even the missteps in Europe and Japan, slow the U.S. economy down, or at least make it harder to push forward, and not send us into a recession, or not even push growth lower than it has been, but a counteracting effect. Our economy strengthens, but we have overseas headwinds. That could be due to currency exchange rates, less demand for exports. The Fed did mention a drop in U.S. exports. So we might not share in a recession with some other foreign economies, but we can't say that we're completely decoupled. And as I've said for years, decoupling is such a ridiculous concept in an ever more integrated world. I even hate to discuss it. So the Fed was also of the opinion that the equilibrium rate, the neutral Fed funds rate, which supposedly neither adds nor subtracts from economic growth, should be around 3.5, down from 3.8. Most bond people, most bond traders and strategists, and even some fixed income oriented economists believe that the neutral Fed funds rate, the equilibrium rate, is probably below 3 at this point. But the Fed's dots keep coming towards the market. And there was another place the Fed dots came towards the market too. The market thought the terminal rate, the highest rate, which is usually above the equilibrium rate, would be around about 270, I think it was the last forecast, in Q1 of 18. Well, the Fed's forecast puts the Fed funds rate in that same range, between 2 5/8 and 2 7/8 at the end of 17. So we go a quarter earlier, it's an eighth higher on the top end. So even the Fed is bringing back its forecasts. And now we have 4 Fed officials, unnamed as they always are on the dots, saying that they don't see the need to raise the Fed funds rate until 16 or even 17, one participant. So we're seeing that the Fed's ratcheting back expectations. Ms. Yellen also made the comment that even with the labor improvement and potential wage increases that we are likely to see, that it's unlikely to push inflation up to that magical 2% area. And she went even further. She said that we should not think as 2% as a ceiling for inflation. In other words, because we see 2% inflation in the U.S. economy does not mean the Fed is going to ramp up interest rates. probably not going to be at zero at that point, but it doesn't mean the Fed becomes restrictive, doesn't have tight monetary policy. So what was assumed was that if the Fed stood pat, did not change rates, that we would have hawkish comments to offset it. We didn't. We had very dovish comments, with the Fed downplaying some of the positive economic, maybe not downplaying, but offsetting that positive economic data with concerns from overseas. When questioned about asset bubbles and whatnot, and the Fed policy being too accommodative, Ms. Yellen went to say that the markets have, and let me see how she put it here, that widening risk spreads in the market have tightened financial conditions. And by that, what Ms. Yellen means, we can only assume, is that the bond market did a lot of the Fed's work for it, especially in the lower quality areas of the bond market. And I can't show this to you through screen sharing. I haven't gotten it approved, but I'm looking at a chart right now provided by Bank of America Merrill. It shows the average credit spreads of high yield bonds over the Treasury benchmarks. And we look at 5 to 7 year B-rated bonds, which are pretty low, but not distressed, let's say. And the spread over Treasuries have gone from 439 basis points this time last year, so that's 4.39% over, to 550, and it was at 619 in August. So we've seen these single B-rated companies get an effective interest rate increase of 1 full point since last year. Now, that could be damaging to single B companies, but might not be devastating, especially since the Treasury benchmarks are low and many of these companies have taken care of most of their financing needs for the next few years. But when we look at triple C companies, now triple C companies and lower are companies that have to come to market sometimes just to get by, just to survive the next quarter, right? They rely on liquidity. Well, last year, the average spread over Treasuries for triple C and lower rated corporates, according to Bank of America Merrill, was 759 basis points on this time last year. That's around to 760, right? It spiked to 1,247 at the end of August, and it's down a little bit to 1,128. Well, let's do the math. We've come up, 420 odd basis points, 427 basis points? I mean, that's a big hike. That's 4.25 points, thereabouts, rounding it off. 4.25 point rate hike if these companies want to borrow. Good luck with that. So Ms. Yellen is right when she notes that the credit conditions, the borrowing conditions in the real economy, in the real bond market, have tightened quite a bit. What this means is that, in the Fed's opinion, it's not under any urgent need to tighten, because the market's doing that already. Now, what we saw after the Fed statement was that junk bonds rally, and we think that's kind of silly, because if you listen to what Ms. Yellen said, Ms. Yellen says one of the reasons they don't have to tighten is because the market tightened for them. So those junk credits are already under pressure, right? And I expect to see some more cracks in the high yield market regardless of this, right? So let's keep going here. The Fed is expecting a long and shallow path for rates. That means that we're probably, when the Fed starts tightening, whenever that is, might be October, doubtful, December, possible, sometime at 16, more probable now. The Fed's probably not going to get every meeting, and we might not see rates go up very quickly when they do start tightening, or very high. The Fed has put the forecast, the median Fed funds forecast at the end of 16 at 1 3/8 to 1 5/8. The bond market's pricing in less than 1%, a 1% Fed funds rate. My guess is that the Fed dots are going to keep coming down towards the bond market. I don't think, even if the Fed waits, where Ms. Yellen thinks the longer it waits, the faster it might have to. Well, the market actually thinks that. Ms. Yellen didn't say quite that, but the market assumes that if the Fed waits longer, or some market participants assume the Fed waits longer, they have to go more quickly. I don't think so. What Ms. Yellen said was that if the economy is stronger, the Fed might have to tighten faster and quicker. I mean, faster and steeper. Or if it's weaker, slower and more shallow. All right, I think what we're going to see is an economy that bumps along in the mid twos, some quarters above 3, some quarters below 2. And that the Fed is going to start later now, obviously, but still go on a shallow path. Bill Gross was on saying that he thinks that the peak Fed funds rate in this cycle might be around 1 3/8 or so, maybe 1 3/8 to 1.5, I think he said. So, I think he's a little low. I'm in the mid twos, maybe in that 2 3/8 to 2.5 range, or 2 1/4, 2.5. But you know what? He's probably more correct than the Fed's forecast of well into the 3s. So where does that leave the markets? Well, if you watch the equity market, the algorithms are running hot and heavy. Every time something dovish came out, the stock market rallied. Every time something that was less dovish, I can't say anything was really hawkish, but less dovish, the stock market would sell off. So when Ms. Yellen started saying that, the Fed's going to be accommodative, but the growth is intact, and the stock market loved it. We were up well over 100 points. And then she said something that shocked the equity market algorithms. I think it was the algorithms, because I don't think any rational person would do this. In a response to a question in the press conference, Ms. Yellen said that the Fed's job, I'm going to paraphrase, I'm not quoting, that the Fed's job is not to prop up markets. Yes, it might engage in market-friendly activity in response to a situation, an economic situation. So it might do something, it might change policy that's pro-capital markets because of an economic situation, but the Fed is not going to react with policy just because the market sells off and the market doesn't like it. Almost immediately, the equity market tanks. It goes down to almost flat, comes up a little bit, and she makes more negative comments on the global economy and inflation, and bang, we finished down 65 on equities on the down for the day. Now the bond market reacted a little differently. After bouncing around a little bit, the yield of the 10-year Treasury started to go straight down. Not super quickly, but it went straight down to where at the time of this broadcast it was at 219, down from 228 before the release of the statement. Okay, and right away, the pundits and even some strategists out there, not fixed income strategists, like global investment strategists, right? The bond market, the long end is rallying because the Fed didn't raise rates. No, that's not what happened. What happened was in the Fed statement and in Ms. Yellen's comments, and you could see when the Fed statement said what I'm about to say, bonds rallied, and then when she said it, bonds rallied more, and that was the inflation forecast. The Fed does not see 2% inflation for years as of right now. Okay? But notice, the Fed says that it saw growth continuing at its current modest pace. What did the long end do? What it always does. It follows inflation expectations. Inflation expectations were lowered, well, the prices of long-term bonds rise, and the yields fall. And now we have the 10-year sitting at 219 and the 30-year long bond sitting at 301. Okay? Folks, we are unlikely to see high long-term rates unless we see inflation pick up. Now, what about tips? Well, the tips rallied along with treasuries. And well, doesn't that bode well for inflation? No. What happened was the market is pretty much pricing in for 10 years a 1.6 inflation rate and 1.28, figure round to 1.3 for 5 years. So all it did was maintain that break even. So once it's at that break even, wherever the 10-year Treasury goes, the 10-year tips tends to follow. So you have that break even, and they're moving in tandem now. Only when that inflation expectation changes will you see the break even move. So if inflation expectations move up, you'll see the break even widen, right? If you see, and then the tips will become more valuable. And if you see inflation expectations deteriorate, the break even will narrow, and you'll see the tips underperform, right? But right now, nothing has changed really what the bond market was pricing into inflation. Now, some of the global investment strategists might have, but they're not bond people, as far as I know. At least not many of them. So it was low inflation that the long end of the curve was pricing to. So, I mean, I read the statement, I read the bullets, I've read commentary on this already, and I don't see any likely situation that interest rates, long or short, are going to rise appreciably. However, as long as we see cracks in the global economy, especially in the EM world, emerging markets, we could see credit spreads stay wide or even widen further. And remember, in times of distress in an economy or in a given area of the bond market, credit markets can go in different direction, the opposite direction as interest rate markets. Now, the most glaring example was during 2008, right? We saw treasury yields plummet and corporate bond yields spike, and prices went in different directions. Well, the same is happening kind of right now in junk. We've seen treasury prices rally over the past couple months, but we've seen credit spreads on corporate bonds, junk corporate bonds, widen out. So the bond market is doing the Fed, or the credit market is doing the Fed's work for it as far as deflating a bubble in junk. So we don't think that it's not time to buy junk. If there's any rallies in junk and you're deep, I'm talking about B and lower, get out. If somebody wants to pay up for it on the Fed bet, get out and move up. Because the farther up you go, the less spread widening we saw, and the spread compression is likely to continue, especially when we have low rates and an improving U.S. economy. So that's where we are. This is just a brief call. Bond Squad's forecast now, 50% chance we see a Fed funds rate range hike, as we like to call it now, by the end of the year. 50% we see it in 2016, and 100% it doesn't matter. Okay, long-term rates are not going to move until we see inflation expectations pick up, and the bond market doesn't see it, and the Fed doesn't see it. And now we have disinflation, not really deflation, but disinflation being exported from overseas. Well, that bodes poorly for higher rates. So that's where we stand here. Once again, the market commentators had it pretty much wrong about what the markets did. The Fed disappointed us in a way, but I was 50-50 going into this. In my morning letter, I did say my intuition says that the Fed wants to stay put here, that the Fed's going to stay put. I was concerned that Mr. Fisher, Stanley Fisher, vice chair, was going to push Michelle Yellen over the edge. He did not, only lacquer and dissented. And we have much more dovish concerns. I really think the Fed is more concerned about overseas developments, including and maybe especially China, than it is letting on. And I think the IMF and the World Bank realized this too, which is why they were both adamant that the Fed not tighten policy here. I really think there's trouble in China. It's not something that they can easily work out of, and there's real danger for the emerging markets in general. If I'm wrong and you move up in quality, you miss out on a little return. If I'm right and you don't move up in quality, you could take a bath here. And remember, EM bonds and junk U.S. corporates are in effect an equity with a coupon. Par should not be expected. You'd like it, you want it to happen, it can happen, might not happen. All right, so that's not for mom and pops. I don't care what size and anything. Mom and pops probably shouldn't play much in that. Let's see if I missed anything here. Yeah, Ms. Yellen said inflation low in the coming months. Lacquer was the only dissenter. And that's pretty much it. Again, low rates for longer, flatter curve at low rates, although we probably see a little bit of steepening here. In fact, we're seeing that now. We have the 2-year, which is up to almost 80 basis points the other day. So they got 68 basis points. So we have a re-steepening, and it's a bull steepening, right? Because it's rallying. The prices are going up. So we're resetting back to a lower rate for longer, and the long end now is flirting with the 10 years now flirting with 2.18, 2.189. So I think it's just more low rates, but wider credit spreads and junk. Move up in quality. Don't expect double-digit returns. Know what you own, and I think the junk bond and tip strategies, that were being hawked all over the street the last year, are going to continue to fall on their face. Need help? Call Bond Squad 570-424-1555. Email me thomas.byrne, that's BYRNE, at WS Whiskey Sierra, the word and M as in Mike.com. Here during market hours. Touch base with me. Say hi. We build individual portfolios using actual securities. No weird algorithms and methodology. You tell us what your goals are. We will build a portfolio for you. No obligation. Give us a call. Have a great night. And we will see you. Goodbye.